Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about what happened in the States there. Not to like an extreme extent, but the effects or the concern that might happen when it comes to Canadian banks. And so I'm just going to share my bias towards Canadian banks as I'm in their favor. As a lot of people may know already, I'm heavily invested when it comes to portfolio weighting in the Canadian bank system. And so I just want to talk about that because there's probably is concern because it seems like everyone now understands kind of what the situation was down the States there with SVB. But I'm not going to talk about that specifically. I'm just going to talk about I'm just going to address the concern that comes with major news that when that happens. So bank failing, because it's a very general term and people typically will take that, copy and paste it and use that same scenario for, let's say, Canadian banks. So we're going to talk about that. So if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So just to give you the Coles notes on what happened with SVB or Silicon Valley Bank, a regional bank in the States, went belly up. And of course, the situation has been taken care of. However, just to give you, again, the Coles notes, what had happened was they had a liquidity crisis with US Treasury bonds, of course. And of course, they lost money on those Treasury bonds because they had to sell them to get access to liquidity to give to their clients, and which caused this word that is another new word. I feel like there's a bunch of new words over this past few years, like contagion, which is very suitable for the situation because a bank run had happened, and that is where, the FDIC, I believe that's the acronyms for it, took over the situation. And it's not just one bank. There was another bank, but it was like a crypto bank. I'm not going to talk about that one. I'm going to talk about SVB. So that's what happened. US Treasury bonds lost value. They bought them when it was free to rent money, essentially, and they lost value because interest rates go up. So the effect of interest rates don't just affect the consumer or people. It affects the infrastructure of the system. And I'm not saying system as a conspiracy theorist. That's what we're just going to call it. Okay. So let's talk about the Canadian banks, because a lot of Canadians are probably thinking, like, if that can happen in the States, which was labeled as the second largest downfall of an institute in history, can that happen to Canadian banks? Absolutely it can. But here's the but part. Canadian banks operate in a very similar fashion, not a similar fashion, but are very heavily regulated. And obviously it is an oligopoly. So major institutes, high entry barrier if you're a new bank and trying to get into that sector by starting a new bank, and so on and so forth. Canadian banks also buy US Treasury bonds as like an asset to make some money, to create cash flow, and so on and so forth. Of course, interest rates have gone up and have caused the value to go down in bonds, essentially. And so if you look at balance sheets balance sheets on all the banks, you'll probably see a section for treasuries or US treasuries, and you'll see the value and then the par value typically, which is the current value. And you'll probably see a loss across the board if you read balance sheets. Now, on the category, it probably says unrealized loss. The key word in all this is unrealized. You only lose money when you sell. So in this case, it would be smart for Canadian banks, which I'm sure they are. They are smarter than me. They are smarter than majorities. They are the movers of money. They understand allocation. They understand the risk. And the greatest thing is that Canadian banks are heavily regulated and they're renowned around the world for safety in banks. Well, Canadian banks, anyways. And so let's talk about that. So they have an unrealized loss. They haven't sold anything. So if anything were to happen where Canadians are going to the banks to withdraw their cash, Canadian banks actually have cash on hand, which they can, of course, give out. Not a problem there. But there's also like a second safety precaution that happens, and that's with the Bank of Canada. All banks have access to $200 billion in cash, roughly, which is a liability for the Bank of Canada. And it's kind of like if Canadians were put money into a savings account and get interest back. It's kind of the same thing with Canadian banks and the Bank of Canada. So the Canadian banks, the major Canadian banks, the big five or big six, whichever, if you want to include the National Bank, which I don't include, they have access to $200 billion in cash with the Bank of Canada. So they don't have to sell off their U.S. treasuries. They don't have to sell off their assets in order to liquidate, to have enough liquidity to give out, cash if there were something to happen like that. They also have a third measure, which happens to deal with the U.S. Treasury bonds or U.S. Treasuries, is if they run out of cash on hand and then they run out of the $200 billion that they have sitting at the Bank of Canada, they actually can put up the U.S. Treasuries up as collateral. And why would they do that? Why are U.S. Treasuries so the piece of information that's important here is because they are technically classified as the safest investment out of all assets for some odd reason. Don't have the details on that, but they are. So third measure is that these banks can actually put up their U.S. Treasuries as collateral to the Bank of Canada for a short-term loan to access liquidity until they figure things out and move forward from it. And so when it comes to bank safety, specifically Canadian banks, this is why I'm biased. That's why Canadian banks are my bias, is that they are pretty organized in the way that they assess risk, where if anything to happen to the economy and so on and so forth, and it's an oligopoly. And so for me, I'm not concerned. And so for those that may be concerned, this is what I'm addressing. The safety of your assets with the bank, especially those cash deposits. I get it. We have CDIC, but that only covers up to, I think, like $100,000. And if you have more than that in one bank, which some people probably do, or spread across all banks, you want to have knowledge and confidence that your assets are where they should be. And so if you need access to more than what CDIC covers, understand that the banks have strategies and safety measures in place to make sure they have enough liquidity to provide their clients, to provide Canadians, to make sure that there's confidence there, because you don't want to lose confidence of Canadians. Apparently we're the nicest people in the world. I might not be, who knows? That's up for debate. Anyways, that is why, if you're concerned about what has happened in the U.S., can it happen to the Canadian banking system? Yes, it can. The chances of it happening, for me, I'm gonna say very, very slim to none in that scenario. But again, that's my bias. I'm just a guy on YouTube that makes videos about investing $100 a week into a tax-free savings account. What do I know? But that's my reasoning for why I believe that the Canadian banks are going to be just okay as long as it's under control. And I'd imagine they know what they're doing, especially the fact that they are the biggest banks, and we don't have a system like the US does when it comes to banks. You can go to like wherever Silicon Valley Bank was, probably California, and then you go to like Michigan or somewhere else, some other state. I don't know much about the states, but they have different banks everywhere. They do have national banks like JP Morgan, Chase Bank, JP Morgan Chase, or whatever it is. They do have those banks, Bank of America, and so on and so forth, but they do have much more smaller sized regional banks, as they would call it. And Silicon Valley Bank, SVB, was a regional bank. It wasn't a national bank. And so when you look at Canada, national banks are national banks. You have credit unions and other things like EQ Bank and so on and so forth, which are these online platforms, online banks, and they are still considered banks, but you do have this strong infrastructure of national financial banks or financial institutes that understand and can assess, the risk, and they have been around, forever, for as long as I know, but almost probably over 100 years. And so Are they going to disappear? Probably not. Are they good at allocating cash? Yes. Are they good at at assessing risk? I believe so. Are they smart? I believe so. And so that's why I continue to invest in banks, regardless of what's happening in the U.S. and their little blip in the banking system. Are there cracks maybe in the infrastructure of the financial system that are showing up? Yes, but that is coming from the increases of inflation, of course. And so that's my take on it. No need, well, you can be, but in my opinion, I'm not concerned about what is happening down there that could affect us. When I say us Canadian banks or just us Canadians in general. I don't see a reason to go and withdraw everything, sell all my assets, and take cash. I believe in our system. I believe in the Canadian banking system. I believe that they will be just okay. And they typically will get through this stuff. So that's my take. Hopefully that provides you guys some value and more understanding of how this could possibly affect Canada and maybe help you just have a little bit more knowledge. So don't forget to leave a like and subscribe, and we'll definitely see you guys in the next one. Bye.